Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our Frac Spread show. I am wearing my kids' school spirit gear. I was told that if my daughter was wearing this shirt, I had to wear mine. So just showing some school support for St. Aidan's. So yay, little things going into the weekend. So with this, so we have our Frac Spread show today. Next week, we're just going to have our EIA show and our Frac Spread show. There won't be too much economic data. If a lot comes out, maybe we'll do 1 or 2 episodes. But again, it'll be fairly quick and easy. And we hope you have some fun for the Thanksgiving holiday. So with that being said, the final number came in at 297. So we had an increase in 2. So we went from 295 to 297. Now, if you remember last week, we said that we could get one more push to 297. It was unlikely we saw 300. Now, one of the interesting little tidbits, there are only 3 areas in the states that actually don't have activity. So we've actually picked up some additional in some of the smaller basins, which is a positive when you look at availability, when you look at some of the activity. And this is what normally happens. You get one last bump as they try to, especially the smaller basins that usually have 1, 2, maybe 3 or 4, just to get that production locked in as you go into year end. And again, it confirms of our view that we're going to have a production of about 12.3 million this year. And then next year, based on just what we're seeing, and we're going to go through it in different details, is that we could get to about 12.7 million barrels a day next year. But that's really it. We would need to see a meaningful jump in frac spread counts to see something get closer to 13.1. And that's why when we look at the growth in production and what we see happening right now, it's not going to be this huge step higher, but really something that's going to be a bit more of a smaller step. And then unless we get either some new type of technological breakthrough, which is always a possibility, we're really going to sit between that 12.7 and maybe 13 million, and that's where the U.S. will be. We don't see much more going forward. And one of the things that we continue to see in the market, and we talked about it in the EIA show, was that the physical market continues to struggle. We have a massive amount of product that is sitting in the market, especially in West Africa and the Middle East. You have a lot of these slowdowns that are becoming a bigger problem when you look at underlying movements, which is why we've seen the differentials and the physical market weaken to try to incentivize more buying. So to say that we're going to stop at 12.7 million next year, that's not a terrible thing, especially when you look at the underlying views of where 2023 production is going to be around the world. But more importantly, where's demand going to be? And demand continues to soften. And we're going to show some data points. Again, very high level. We talk a lot about it on the Econ show, so I'm not going to belabor the point here. But I want to show how that ties back to crude demand and what has happened over the historics. So when we look at rig count, here you can see rig counts went up by 3. There was 1 additional oil, 2 additional gas. More importantly, there were 3 additional horizontals that came to market. So now we're at 714 rigs that are operating. It continues to be the horizontal is the one that matters the most. Vertical, directional will come up and down. Typically, you'll have, especially when you're getting into kind of this production mode or manufacturing mode, if you will, you'll have a vertical run ahead, drop the vertical well, and then you'll have the horizontal come. It saves money, increases efficiencies, and that's something that we continue to see. But when you look at DUC counts, we actually had DUCs go up a very small amount. But it's in line with what we've been saying, is that we're getting to a flattening point, and we're here. And the idea is what is necessary to have a very stable profile of production. Because in the past, when you look at what was happening from 2017 into 2018 into 2019, there was this massive move of, we're going to complete a ton of wells, production is going to go to the moon. It's like, well, timeout. Like, you need pipe to do this. You need a lot of infrastructure to do this. And we have said, I personally have said, when I was at Bloomberg, I've said it since Bloomberg, is that these lofty numbers of, the U.S. is going to produce 17 million, 19 million, it made no sense. We physically don't have the capacity to export that kind of volume unless we're building a lot of offshore loading units similar to Loop, because our waterways are fairly narrow. They're shallow, which is why we do a lot of lightering. For those that don't know what lightering is, it's when you use a smaller boat, load it up with a product, and then move it to a bigger boat further offshore where there's deeper clearance. So there was never really and let's be fair, there isn't that kind of demand for light sweet crude, especially our quality. So it was, I've always been saying that this is ridiculous. You're not going to see that kind of momentum. And where we're going to find some steady state. And then obviously 2021, companies were trying to manage costs, trying to protect themselves. 2020, when you look at when they were trying to bring stuff back, it was an idea of, okay, let's protect decline rates. Because a company can't let a company as an E&P, can't let their decline rates get to 20, 25%. The cost of overcoming that hurdle is massive. So the idea was, can we get somewhere between 10, 15%, but really 12, 13% decline rates is manageable. And that was when you saw rigs remain and drop off, and you had this big push for completions, which continued to arise. And that's why when we look at the spread, we're coming to a fairly stable, we could get maybe a little bit more activity on the frac spread side. Obviously, we're getting a little late in the game here. And next week is Thanksgiving, which is why you have one last push this week. Then you have a steeper drop off next week. And then that drop off will continue through year end, because that 6-week period, you see a decent amount of slowdown. And that's going to play out here. But when we look to January, we expect to be at about a 0.4, 0.41, which is a manufacturing process. And that's where we're starting to see this get created. And I think it's very likely that we'll see that going forward, especially when the importance of our product going into the international market, especially on the NGL side. Now, I've talked about it a lot, and I thought this was really important, because when you look at the work week and you look at people working from home, as we say, as we show every week on the EIA show, specifically segment 2, we show you what is happening based on the Google mobility data. And every single day, on a 7-day rolling average, people going to work is 20% lower than normal. And this just looks at how things have changed or haven't changed. So average days per week working from home after the pandemic ends, employer plans are about 2.3. Again, 2 to 3 days from home, and the flexible schedule is becoming very attainable, and we're seeing more and more of it. Percentage of paid full days worked from home, you can see the amount that is being increased and factored in, and you're not seeing a very steady decline. You're finding kind of this comfort point, and I think this is a bigger impact to that permanent shift on the gasoline front that we've not only been calling for since the beginning of the pandemic, shown with data how it is here, and then continue to talk about how it's here to stay. Now, it obviously reached a massive peak during the pandemic. We never said that full work from home was the way to go. We've been saying from the beginning, flexible schedules. You're going to have, on average, 2 to 3 days per week at home. And that's going to pull back a decent amount of Monday to Friday spending and just gasoline consumption when you look at that profile, which has continued to play out in the data sets. Now, when you take a weaker global economy, which we have been talking about what feels like incessantly, and I apologize, and we try to use data to reinforce it, I think this is a really interesting backdrop when you look at the weaker global economy and what that means. And now, unfortunately, this chart doesn't go back to the 70s, because this is not me sitting here saying, because of this, crude is going to $40. I am not saying that, because we do have supply issues. We do have quality issues. And when you look at Saudi Arabia, when you look at OPEC, they've said that they are willing to cut to support price, and you've gotten this back and forth. Obviously, Russia is a big unknown in terms of what they're going to export. The Iranian protests continue, how much volume can come out. Libya, the different sanctions continue to fight over dealing with Turkey, dealing with Europe. How are you going to explore the Mediterranean? You're respecting EEZ zones or infringing on them. So there is a lot of unknown. I am not saying that. And that's why I think there is some staying power in that $70 range. But activity coming down, manufacturing coming down, as we've said before, and for those that are in the commodity space, that copper, nickel, lithium, industrial processes, both from the raw material to the finished product, require a lot of diesel. And as you get a slowdown with now PMIs fully in contraction, all of the leading indicators showing further contraction, you're going to have less demand on the industrial side. We've already seen that slowdown in key areas, and that's continuing, which again is going to pull down that oil demand, and that's going to put some additional in storage. But we have the SPRs going. So as the SPR slows, well, some of that excess from slower demand is going to replace that. And you have some of these shortages in different cargo, in crude types, but there is a lot of crude on the water, and it's growing because you're seeing this play out in real time. So that's why I think you'll see that SPR fall away in December. You'll have some of that come back in terms of, that slowing demand. And we're just going to hang around in these storage levels around the world, not so much driving us to $250, but also not sending us to 40. I think sometimes cooler heads need to prevail in terms of where is the right price for crude. And I think we're starting to find that as the floating storage grows, as physical markets weaken, as differentials widen, because countries are trying to find the right price to clear. Here's just another example. Weakening CAPEX outlook weighs on manufacturing output because you have people, countries, companies, when you look at Empire State, Philadelphia, Kansas City, all of the regional data within the U.S. and all the leading indicators abroad show a weakening of exports, show a weakening of industrial capacity. And that, again, with CAPEX rolling, you're just not going to see investment. You're not going to see the same type of movement, which is going to result in less diesel demand, less trucking demand, less shipping demand, again, marine gas oil. And that, again, is going to just be that downward pressure on demand. But you still have that supply. What is OPEC going to do? They've been cutting already. We have West Africa that has been unable or unwilling, really, just based on their demand profiles, to increase production. So you're still going to have this back and forth, which is why I talk about this more like the 70s versus the 08, because of those shortfalls. Looking at the leading indicators, the OECD leading indicators, purely in contraction and getting worse. In the U.S., this is the U.S. leading index. You can see it's at negative 0.8. And when you look at similar periods, we were either in a recession or imminently about to enter one. And that's why, again, looking at the data sets, looking at the underlying, what the market is telling you, there is going to be a demand problem. Now, with that being said, there's a lot of problems, which is keeping demand for U.S. crudes fairly stable. So when you get this big drop or a drop in crude demand, it doesn't necessarily mean that you're going to see U.S. demand drop or U.S. Demand for U.S. crude to fall. Will we be at 3.8 million barrels a day of demand into the international market? Probably not. But could we hold in at 3.3 to 3.4? Sure. So that additional 400,000, you're using round numbers, instead of it going into the international market, could help replace what the SPR is trying to backstop. So the SPR sales stop. That excess that is no longer being exported goes and supplements, and now we're back to a more balanced market where we're not using the SPR, and you're starting to see some of that leveling off of activity, which is going to be an important thing to watch as we go into next year. Then we take that and just looking at it on a different level, the diffusion index of every possible yield curve inversion, you get an idea that This is and inversions to this level, you're either in a recession or heading into a recession, and you can see just how clear multiple indexes, leading indicators, exports, new orders, the rates are showing you what is happening, which again is going to be a problem for diesel demand, for gasoline demand, and underlying obviously crude demand. The issue is going to remain in terms of price, because gasoline, as we've been saying, gasoline prices are going to come down, but there's some support in terms of diesel demand at the diesel price at this point because of the lack of storage and because we're heading into winter. So even as trucking slows, you're still going to have that heating oil piece, but that's going to leave a lot of heavy resid and heavy distillate resid in the market, and that's where we should see some flipping from countries that are using middle distillate and diesel for their power burn, moving towards the heavier high sulfurs and high sulfur fuel oil. So that's what we have for you today. Hopefully it was helpful. If you have any questions, please let us know. Again, next week we'll have our FSC show. We'll have the EIA show. Maybe we'll do maybe one episode of just the econ and try to put everything together. But that's we'll let you know as we get there. And we all know everyone's going to want to spend time with their family and not hear me rant and rave like a lunatic. So maybe it'll be everybody save some time. But otherwise, we hope you have a great weekend. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.